Hello, Assalamualaikum everyone. Let's begin by understanding liquidity. This refers to a company's ability to pay off its short-term debts as they come due. We will access this using two key metrics. The first one is the current ratio and the second one is the quick ratio. Firstly, the current ratio. The current ratio is calculated by dividing a company's current assets by its current liabilities. In this case, it is calculated by dividing 2,050,000 by 575,000, resulting in a current ratio of 3.57 times. This means DURAH LTD has 3.57 units of current asset for every 1 unit of current liabilities. Although it's slightly below the industry average of 4.3 times, it is still considered strong. This indicates that the company can comfortably meet its short-term obligation and is managing its working capital well. Secondly, quick ratio. The quick ratio shows how well the company can cover short-term debts using only its most liquid assets, excluding inventory and prepaid expenses. The quick ratio is calculated by subtracting inventories and prepaid expenses from current assets, then dividing the result by current liabilities. In this case, it is calculated as 2,050,000 minus 1,245,509 divided by 575,000, resulting in a quick ratio of 1.40 times. A quick ratio of 1.40 means DURAH Ltd can cover its short-term liabilities without needing to sell inventory or rely on prepaid items. This is significantly above the industry average of 0.97, showing excellent liquidity strength and faster access to cash. While DURAH Ltd current ratio is slightly lower than the industry, its quick ratio is higher, and making it a standout performer in terms of true liquidity. To conclude, DURAH Ltd has demonstrated strong liquidity performance. Firstly, its current ratio shows it can easily cover daily operational needs. Next, its quick ratio proves it has enough liquid assets to face urgent financial obligation even better than the industry average. This reflects healthy short-term financial management, giving the company confidence and flexibility to operate and grow.
Next, I will talk about historical analysis DURAH Ltd current performance. In 2024, DURAH Ltd showed a few signs of improvement compared to the previous year, but there was also areas where the performance dropped. One positive sign is that the inventory turnover went up from 4.36 to 5.01 times, which means the company was able to manage and sell its inventory more efficiently. This could suggest better stock control or higher sales. The days sales outstanding (DSO) also improved slightly from 25 days to 34 days, which showing that the company is collecting payments from customers a bit faster than before, which is good for cash flow. However, there were also some areas of concern. The fixed asset turnover dropped from 6.2 times in 2023 to 4 times in 2024. This means the company was not using its machinery or equipment as effectively as it did last year to generate revenue. On top of that, the total asset turnover also fell from 5.1 times to 3.9 times. This shows that DURAH is not using all its assets as efficiently as before, which is could impact its overall performance if not addressed. So overall, while there was small improvement, especially in inventory and collection, the drop in asset efficiency in something the company needs to work on. Next, I will evaluate DURAH LTD overall performance in 2024 relative to its competitor using all four ratios. Overall, DURAH LTD seems to be performing weaker than its competitor NBU and Flexwell Corp when we compare all four financial ratios. For inventory turnover, DURAH recorded 5.01 times, which shows it is managing to sell and restock its inventory well, but it still fails behind NBU with 6.22 times and Flexwell with 5.89 times. This suggests that the other two companies are doing a better job in managing stock, while for days sales outstanding, DURAH takes the longest time to collect payments for its customer, which is 34 days, while NBU collects in 26 days and Flexwell in 29.3 days. This lower payment collection could cause cash flow problems for DURAH LTDs, especially when it comes to covering their short-term expenses. Looking at fixed asset turnover, DURAH result is 4 times, which is much lower compared to NBU at 7.03 times and Flexwell at 7.6 times. They show that DURAH is not using its fixed asset like buildings and its machinery as efficiently to bring in revenue. And the last ratio, total asset turnover DURAH, its score is 3.9 times, which is again is lower than NBU CO 6.4 and Flexwell Corp 5.3. This means that when it comes to using its total resources to generate sales, DURAH is still behind. In conclusion, DURAH ranks last in all four ratios, which clearly shows that it's not performing as efficiently as its competitors. While there may be internal improvement, but the company still needs to work on managing its asset and collection to stay competitive in the market.
Assalamualaikum, my name is Nur Izibin Kamar Hizam. Today I will present performance evaluation of DURAH LTD. This is the performance evaluation of DURAH LTD in 2024. Although DURAH LTD made some improvement compared to last year, it is still behind its competitors, NBU Co and Flexwell Corporation, in managing its assets well. For example, DURAH inventory turnover went up from 4.36 times to 5.01 times, but this is still lower than NBU 6.22 times and Flexwell 5.89 times. DURAH also reduced its day sale outstanding from 35 to 34 days, but NBU collect payment faster at 26 days and Flexwell at 29.3 days. A bigger concern is that DURAH fixed asset turnover dropped from 6.2 to 4 times, while NBU and Flexwell reached much better numbers, which is 7.03 times and 7.6 times. On top of that, DURAH total asset turnover also fell from 5.1 to 3.9 times, compared to NBU 6.4 times and Flexwell is 5.3 times. This shows that even with small improvement, DURAH is still having trouble keeping up with its competitors when it comes to using its asset efficiently. Next, I will present 2 key recommendations where DURAH LTD can improve its asset management performance to better compete with its rival. First, enhance asset utilization. DURAH LTD currently use outdated machinery which affect efficiency and increase downtime. Upgrading equipment can improve reliability and output. Investing in modern technology and automation will help speed up process, reduce error and boost productivity. Optimizing production schedule will also make better use of machine and labor. This step will improve fixed asset turnover without needing major new investment. Second, improve receivable collection. DURAH should apply stricter credit policies to reduce late payment. Giving early payment discount can encourage faster customer payment and improve cash flow. It also important to follow up on overdue accounts. This will reduce the time it takes to collect money, lower the outstanding sale and help DURAH use its cash more effectively. By focusing on these two areas, DURAH can improve asset efficiency, increase sale and stay competitive in the market.
I will be assessing the debt management performance of DURAH LTD in the year 2024. I will walk you through 3 important financial ratios that reflect how well the company manages debt. Then, I will explain why healthy debt management is crucial for the company's long-term sustainability. First, we have the debt ratio, which tells us how much of the company's assets are financed by debt. Using the formula, debt ratio equals to total debt divided by total assets. That's 1,475,000 divided by 4 millions, which equals to 0.37 or 37%. This means only 37% of DURAH LTD's total assets are financed using debt. That's a good sign, and it shows the company is not too dependent on borrowing, which lowers financial risk. Next is the debt to equity ratio, which compares how much the company has borrowed to how much has been invested by its owners. Using the formula, debt to equity equals to total debt divided by total equity. That's 1,475,000 divided by 2,525,000, which equals to 0.58 or 58%. So, for every 1 unit of equity, the company has about 0.58 units of debt. This reflects a balanced capital structure, meaning DURAH LTD is using debt responsibly while still maintaining control over financial risks. The final ratio is the time interest earned, which shows how well the company can pay its interest expenses. TIE equals to EBIT divided by interest expenses. That means 760,000 divided by 60,000, which equals 12.67 times. This means DURAH LTD earns more than 12 times what it needs to cover its interest payment. That's an excellent position to be in. It signals strong financial health and very low risk of missing payment. So next, do you guys know why is healthy debt management is important? There are 2 key reasons. 1. Avoiding cash flow constraint. Too much debt can eat up a company's income through loan repayments and interest. But DURAH LTD keep its debt at manageable levels, so there's still enough cash for operation and growth. The second point is preserving financial flexibility. Excessive debt makes it harder to get funding later. But by managing debt wisely, as we've seen, through their ratio, DURAH LTD build trust with investors and lenders. This gives them flexibility to invest in opportunities and plan for the future. In summary, DURAH LTD's debt management in 2024 is financially strong and well balanced. Only 37% of its assets are funded by debt. A 58% debt to equity ratio shows good leverage, and a TIE ratio of 12.67 times prove excellent interest coverage. This position the company for long-term success, sustainability, and future growth. That's all from us. Thank you. Bye-bye.